second part of Chapter 23, we will be looking at how to understand variances for direct materials and direct labor. Before we do that, we should talk a little bit about the characteristics that we want if we're going to use budgeting for control. That means using the budget to evaluate managers. We should be using participative budgeting. Remember, that means bottom-up budgeting, rather than having top management tell each department or division how much resources they get for the period and hope it works. We should construct the budget from the bottom, allowing each department or division to have input into what they need in order to accomplish the period's goals. We should also make sure that the standards that we set are realistic, not too lax, but not too strict either. Very strict standards are actually demotivating. In addition, we should give frequent feedback on performance. And we should focus on those costs that the managers actually can control. Monetary incentives for reaching budgetary goals, like a bonus, are always welcome, but non-monetary incentives are welcome too, like a designated parking space or being named Employee of the Month. Multiple performance measures are key. Remember, we are what we are rewarded to be. So be careful what you reward, because that is what you're going to get. For example, if you tell workers that you want them to do their job more quickly, and that's what you reward, that's what you'll get, even if it means that they're likely to make more errors. There are three basic approaches to assigning costs in a manufacturing firm. In actual costing, the firm assigns the actual direct materials and direct labor costs that go into a product. It also assigns actual overhead. This doesn't work well for most firms for two reasons. First, because it's often very difficult to tell how much overhead actually went into various products. And second, the overhead costs often aren't known until the end of the period, so it would be difficult to determine the cost of products made earlier in the period. In normal costing, materials and labor are assigned at actual, but manufacturing overhead is assigned based on budgeted costs. This is the method that we've been using throughout the semester because a predetermined overhead rate is really a budgeted cost based on the expected overhead and the expected amount of the allocation base determined before the period starts. In standard costing, the firm develops standards for how much material and how much labor should go into a particular product, and develops standards for overhead as well. This method is used by most very large manufacturing firms. price standard, abbreviated SP, is what the firm expects to pay for a gallon or a pound or an hour of a particular input. A quantity standard, abbreviated SQ, is how much of that input is expected to go into a unit of the product. Therefore, we can say that the standard price times the standard quantity gives us the total cost for that input for a particular product. There are several ways to set standards. Ideal standards would be the firm's expectations of how much it should cost for a particular input in terms of price and quantity if things go perfectly. However, things don't always go perfectly. Choosing an ideal standard can actually be demotivating. A better strategy is to choose attainable standards. How much should the firm use and how much should it cost for various inputs if things go well? Another philosophy is Kaizen standards. This is the philosophy of continuous improvement. Each period, the standards get tighter and tighter to motivate people to do better. Firms use standard costing in several ways. In terms of managing costs, these standards become benchmarks, that is, expectations of how much material, how much labor should go into a particular product so that employees know what's expected. In addition, standard costing helps with the budgeting process when the firm plans for the future. Once the period ends, the firm can use standard costing for control by comparing the actual results to the expectations and deciding what is working well and what needs to be improved. Standard costing also helps the firm to choose among various alternatives. We'll talk more about that in a later chapter. Finally, standard costing helps the firm to determine how much it costs to make its products so that it can determine what is an appropriate market price when it wants to sell the products. A variance is the difference between what was expected and what actually occurred. It could be the difference between an actual cost and a budgeted cost, or it could be the difference between actual revenue and budgeted revenue. But remember, we don't use negative signs in variance analysis. We mark the variance for a revenue or a cost as favorable or unfavorable. A favorable variance would occur if the actual cost is less than the budgeted cost. It means that the firm spent less money. Or if the actual revenues are greater than the budgeted revenues. It means that the firm actually got more revenue than it would have expected. An unfavorable variance occurs if the actual cost is greater than the budgeted cost, or if the actual revenue is less than the budgeted revenue. But remember, these designations, favorable or unfavorable, don't necessarily mean good news or bad news. It depends on what caused that variance. The total variance for any material or labor or overhead item is equal to the difference between the actual cost for that item and the budgeted cost. Mathematically, we could say that it's the difference between the actual quantity at the actual price and the standard quantity at the standard price. But there's a problem with this formula because there are two things that might cause the variance. One is a difference between the actual quantity used and the standard quantity, and the other is a difference between the actual price paid and the standard price. Therefore, in order to understand why the variance occurred, we need to break this total variance down into two parts. One part is called the price variance. That is, what is the effect of the difference between the actual price and the standard price. Mathematically, that would be the change in price. That little triangle is the Greek letter delta, which means change. So the change in price between actual and standard times the actual quantity. In other words, how much dollar difference did it make that the firm paid a different price per unit than it expected times all of the units of that item that the firm acquired. The other component of the total variance is called the quantity variance, or it's sometimes called an efficiency variance or a usage variance. The formula is the change in quantity between what we actually used and what we expected to use, multiplied by the standard price. In other words, this formula is saying how much dollar difference did it make that we used a different amount than we expected, assuming that there was no price variance. That way, these two formulas separate out the effect of price from the effect of quantity. If they are computed correctly, then adding the price variance to the quantity variance should yield the total variance. Let's look at an example. Acme Widgets has collected some information for its manufacturing process relating to direct materials. Before the period started, they thought that they were going to make 250 widgets, but in fact they actually made 300 widgets. Before the period started, they had an expectation that they would use 25 pounds of their direct material for each widget and that they would pay $2 per pound. In fact, they used 7,800 pounds of their direct material and they paid $2.50 per pound. Let's see if we can do a variance analysis based on this information. Let's see if we can figure out what the budgeted cost for direct material would be at the actual activity level. The firm made 300 units. That's the actual activity level. If they used what they expected to use, 25 pounds per unit, that means they would have used 7,500 pounds of material. At the budgeted price of $2 per pound, that would be a total cost for direct material in the flexible budget of $15,000. We can also figure out the actual cost at the actual activity level by taking the 7,800 pounds that the firm used and multiplying it by the $2.50 per pound that the firm actually paid. And that tells us that the actual cost at the actual activity level was $19,500. The difference between these two numbers would tell us the total direct materials budget variance for the period. It doesn't matter which number we subtract from the other one because we're not using negative numbers. And we find that the variance is $4,500 unfavorable. The reason it's unfavorable is that the firm paid more for the materials that they used than they would have expected to, according to the standards. So why did this happen? There are two possible sources of that $4,500 unfavorable direct materials cost variance. One possibility is spending more on the materials than they budgeted, and the other is using more direct materials than they budgeted. Or it could be a combination of both factors. Let's see if we can disaggregate, take apart the total cost variance for direct materials into its components. We just figured out that the total direct materials cost variance is the difference between the actual quantity at the actual price and the standard quantity at the standard price. And we determined that it was $4,500 unfavorable. But we need to break this variance apart into a price variance and a usage variance, or it's sometimes called a quantity variance or an efficiency variance. The formula for the price variance is the actual quantity that was used times the difference in price between what was actually paid and what was expected to be paid. Let's see if we have all of the data for this formula. We were told that the actual quantity of material that the firm used was 7,800 pounds, and the actual price paid was $2.50 per pound. We were also told that the standard price for the material was $2 per pound. Let's plug these values into our formula. The price variance for direct materials is going to be the 7,800 pounds of materials that the firm used times the difference between paying $2.50 per pound and paying $2 per pound. It turns out that the price variance is $3,900 unfavorable. In other words, that little 50-cent per pound unfavorable variance caused the firm to spend $3,900 more on material than they expected. The formula for the usage variance is the difference in quantity between what was actually used and what was expected to be used times the standard price. Let's see if we have all of the information that we need. We were told that the actual quantity used was 7,800 pounds. But they didn't tell us what the standard quantity would be. However, we do have enough information to figure it out, because we know that the firm made 300 units during the period and that the standard per unit is 25 pounds. When we multiply that out, that means that the standard at the actual level of activity, 300 units, would be 7,500 pounds. The standard price was given $2 per pound. Now let's put this information into the formula. The formula says that the usage variance is the difference between using 7,800 pounds to make units this period and using 7,500 pounds to make those units times the standard price, $2 per pound. That works out to $600 unfavorable usage variance. In other words, because the firm used 300 pounds more than expected to make these units, then at a standard price of $2 per pound, it cost the firm $600 more than expected. If we add the price variance and the usage variance, we get the total direct materials cost variance. So, what might explain the firm's $3,900 unfavorable direct materials price variance? There are several possibilities. Obviously, the firm paid more per pound than budgeted, but why did that happen? It could be that they didn't bid for the lowest price for the materials that they needed. Or it could be that they bought better quality materials than expected. Alternatively, maybe the firm's bookkeeper failed to take the discount for early payment. Variance analysis will tell you places to look for an explanation, but it won't tell you which explanation is right. As a good manager, you still have to go and check all of the possibilities to identify the source of the variance. So why did the firm's $600 unfavorable direct materials usage variance occur? Obviously, it means that the firm used more direct materials in each unit than expected. That could have happened because of waste, or it could have been spoilage, or maybe somebody in the firm is stealing materials, or maybe it was caused by poor quality materials. Again, variance analysis will tell you that there's a problem, but you still have to go and talk to different people in the organization to find out why the problem happened. Now let's take a look at the firm's direct labor variances. Since direct materials and direct labor are both variable costs and they are traceable, the process is very similar. We're given some information about Acme widgets for the same month. In other words, the firm had budgeted 250 units and actually made 300 units. We're told that the budget for direct labor is 1 direct labor hour per unit at a wage of $8 per labor hour. But in fact, the firm used 325 labor hours and paid $8.20 per labor hour. Let's see how we can understand the firm's use of labor. The budgeted cost at the actual activity level for direct labor will be the 300 units that the firm actually made times 1 direct labor hour per unit. That would be 300 direct labor hours. Multiply that by the $8 per labor hour that the firm expected to pay, and that tells us that the budgeted cost to make these 300 units would be $2,400. The actual cost to make the 300 units would be the 325 direct labor hours that were used times the $8.20 that were actually paid per labor hour. When we compare the budgeted cost at the actual activity level to the actual cost at the actual activity level, we find that it cost the firm $265 more than expected for the direct labor in these units. Let's see why that happened. We just figured out that the total direct labor cost variance was $265 unfavorable by comparing the actual quantity of labor used times the actual price paid per labor hour to the standard quantity that the firm expected to use times the standard price per labor hour. But that doesn't help us to understand why this might have happened. We need to split that total variance into the part that relates to price and the part that relates to efficiency. The formula for the price variance is the actual quantity of direct labor used times the difference in price between what was actually paid and what was expected to be paid per labor hour. Let's see if we have all the information we need. The actual quantity of labor was given, 325 labor hours. The actual price paid per labor hour was $8.20. And the standard price that was expected to be paid was $8. Let's put this information into the formula. The direct materials price variance will be the 325 labor hours that the firm used times the difference between paying $8.20 per labor hour and paying $8 per labor hour. This gives us a total price variance of $65 unfavorable. In other words, because the firm paid 20 cents per hour more than expected for all the labor hours that the firm used, it cost the firm an extra $65. Now for the efficiency variance, or quantity variance, or usage variance. The formula is the difference in quantity times the standard price. Let's see if we have all of the information we need. We were told that the actual quantity used was 325 direct labor hours. But what about the standard quantity? We have enough information to figure that out because we were told that each unit was expected to take 1 direct labor hour. Therefore, for the 300 units that were actually made, that would be 300 labor hours. The standard price was given to us as $8 per labor hour. So let's put this information into our formula. This formula says that the efficiency variance for direct labor is going to be the difference between using 325 labor hours and using 300 labor hours times the standard price of $8 per labor hour. That is $200 unfavorable. In other words, because the firm used 25 labor hours more than expected at the standard price of $8 per labor hour, it cost the firm $200 more than it expected. And we can add the price variance and the efficiency variance, and it does in fact equal the total direct labor cost variance. So what might explain the firm's $65 unfavorable direct labor price variance? Obviously, the firm paid more per labor hour than it expected. But why? The most likely explanation is that workers got a wage increase. Although it's also possible that the plant manager chose different workers who were at a higher wage rate. So why did Acme's $200 unfavorable direct labor efficiency variance occur? Obviously, the firm used more direct labor hours in each unit. But why? It could be that they're not well trained, so they can't do the job within the standard 1 hour per unit. Or it could be that they had poor quality materials to work with, so it wasn't their fault, but it did take them longer. Or it could be that the machines kept breaking down, extending the time needed for the workers to produce the units. Another possibility is that even though the workers had gotten a 20-cent per labor hour wage increase, they were hoping for more. Disappointed workers don't always work very efficiently. Things don't always happen the way they're planned, so it's reasonable for a firm to expect a certain amount of random variation around its standards. Most firms practice management by exception. That is, the firm sets a range of acceptable performance. That range would be the standard, either plus the acceptable variation or minus the acceptable variation. Anything within that range can be ignored. It's too small to worry about. But anything that's outside of that range should be investigated, whether it's favorable or unfavorable. This is the end of part 2.